Hello and welcome to Leading Voices. Today I'm joined by Richie Whitt, Co-CEO of Markel. Richie, thank you for joining us today.
Thank you, Michael. Appreciate you having me today. Great time here at the end of the year, getting ready to begin a new year to talk about the future of the industry and talk about Markel's strategy.
Great. Well, you've described market conditions as the best since the early 2000s. What is your outlook for 2022?
Well, I think it's a great time to be in the business. I think 22, we will continue to see good market conditions. I did say that, and the current hard market, I'll call it a hard market, it's different than the one that we had from, say, 2000 to about 2006. That market was really driven by the destruction of capital. This market seems to be more about zero interest rates, or very close to zero interest rates, inflation, and then an uptick in social inflation. Social inflation's always been around, a new thing, but more teeth recently than it might have had in the past. So I think those are the things driving what we're seeing right now. And I think it's creating an environment where certainly we are pushing for rate to make sure we're staying ahead of those issues. And I think other carriers are pushing for rate as well to make sure, we're all trying to make sure we generate appropriate returns for our capital. So we really think the conditions should continue through 2022. We've got a pretty optimistic assessment for 22. And actually, that's probably improved over the last few months. We might not have thought that as much a few months ago, but in the third quarter, we saw some rebound in terms of market dynamics.
Well, yeah, following up from that, you said on your Q3 earnings call that rates felt like they picked up some momentum after previously dropping off a little bit. How do you expect rates to change heading into next year and beyond?
Yeah, I think we're still going to see rate increases. They did pick up a little bit in the third quarter. It wasn't substantial. I think the CIAB survey came out a couple of weeks ago, and they showed a small kind of rebound from the moderation that we've been seeing. But we think rates should be pretty good. Now, it's a cycle, it's a market. They may continue to trend down some, but we expect positive rate increases as we go through 22. Again, we think it's for the factors I discussed earlier. I think it's the interest rate environment and the uncertainty around inflation and social inflation that's driving it. And I think it's really stiffened people's resolve. And I probably wouldn't have had as quite a positive sentiment for 22 back in the first quarter. I think we did start to see things come off, but they stabilized. They showed they had some staying power in terms of rates, I believe, over the last few months.
Sure, yeah. How would you compare the growth opportunities in the insurance and reinsurance markets? And in which lines are you seeing the greatest opportunities?
Sure. I still believe, and I've said this before, I believe insurance is still a little bit ahead of reinsurance, but I would say that reinsurance has closed the gap considerably during 21, already getting into next year. It's definitely closed the gap, but I do think insurance is a little bit better. And I think part of that would be, we have a hard market, we have a good market. Insurance companies are going to start to look at whether they can keep more net. And I think that does put a bit of a cap on what reinsurers might be able to push for. Again, I said, this market's different. There's plenty of capital. So I don't think insurers need to be looking for capital to support their business. They're looking for reinsurance partners. And if they so choose, I think most of them probably could keep a bit more net right now. And it's probably putting a little bit of a ceiling on what reinsurers have been able to push for. Mm-hmm. That being said, I think the market is really good on the insurance side. And now I think the reinsurance market has become really good as well. We're seeing in the product lines that we are big in, both on the insurance and reinsurance side. Professional liability probably leads the way in terms of what you can achieve in terms of rate and term. After that would probably be general liability. And, a sore spot in the market for the last 5 years has been property, right? But, just given everything that's happened, property rates and terms are heading in the right direction now. So we also think, in this kind of market, we want to work on developing our multi-line capabilities and really going deep on industry verticals. Mm-hmm. A vertical that we've been good in over the years, very good in over the years, over 30 years, is registered investment advisors. And we write over 4,000 of those. And one of the things we want to do right now to continue to take advantage of market conditions is really kind of build out our product suite for registered investment advisors. We know those guys well. It's been profitable relationships for us. We want to try to go deeper on that. Another example of a vertical that we want to go deeper on is construction. We're already very large in construction. We write over $1 billion of premium in construction. But again, we think there's a multi-line opportunity to really wrap those customers with our product suite and really grow with them, help solve their problems, but also grow with them. So we think we've got the opportunity to build the preeminent specialty insurer. And the way we're going to do that is by continuing to build out our tools and capabilities to help our customers, solve their most complex risk management and risk transfer needs. And so, this is a great market to be in, to be able to really try to push and make progress on that goal.
Absolutely, yeah. Okay, we've seen a number of new entrants in the past few years. What impact would you say the new capacity in the insurance and reinsurance market has had?
Yeah, well, again, and I try not to be repetitive, but this market's not, I don't really think this market has been driven by capital. There was plenty of capital when this market cycle, this part of the market cycle started. There's still plenty of capital. The incremental capital that came in with the startups, it was not that significant. I would say they've had an impact on the margin. Everything has an impact on the margin. I'm certain sort of those last bits of placements were possibly easier to do because of some of the new entrants. So maybe they've put a little bit of a ceiling on what prices could do, but I would point out that prices continue to go up. So it's only been so much of an impact that those new entrants have had. I also would say, they're dealing with the same issues and environment that all the incumbents are. They need to make a reasonable return for their capital providers. Their interest rates are essentially zero, and there's inflation to be concerned about. So I think that is helping to make sure these new entrants are being responsible as they come into the market.
On the reinsurance side, you transitioned your strategy for property in the past year with the line moved to be managed by the ILS operations. Why was this done, and how do you view the property reinsurance market going forward?
Well, maybe I'll start with how I view the property reinsurance market. It's been a tough 5 years. I don't have to tell anybody that. We've all experienced it. But I'm very optimistic about the property reinsurance market. We're 3 years of price increases. I think we're looking at price increases again at 1/1 and in 22. And not just price increases, but terms. I mean, terms are so critical, and we don't talk about them enough sometimes. Certainly, there's been lots of price increases in the property market, but I think the terms have been cleaned up substantially as well. So I'm very optimistic about the property market right now. We felt like we needed to make a decision. Property cat risk, it's an existential risk to an insurance company. But for the larger financial markets, it's diversifying risk. And we believe that the lowest cost of capital is going to win in the long run. Our balance sheet is likely not going to be the lowest cost of capital for cat risk because it is an existential risk for us. Pension funds and others who are investing a very small portion and have a very long time frame, and it's a diversifying asset, they are likely going to be a lower cost of capital. And we tried to recognize that fact, and rather than fight against it, participate in that trend. And so through our Nephila operation, who is I think the longest running ILS manager out there, 24 years and counting. That's really where we wanted to put our chips, behind Nephila and their expertise and their track record, knowing that over time, lowest cost of capital wins. And we want to, we know we need to be able to provide catastrophe risk coverage to insureds. And we want to be able to do that. We still write catastrophe risk on Markel's balance sheet, but we really had to kind of adjust it to what our appetite is and our appetite for volatility, quite honestly, in terms of our earnings. So we're still a meaningful writer of catastrophe risk at Markel, but we truly believe in the ILS model, and that over time, the ILS model will continue to grow because it is accessing a part of the market that can provide a lower cost of capital to these insureds.
You recently announced you'd wind down the Lodgepine retro fund manager. Why did you do this? And what does that symbolize about conditions in the wider retro ILS market? In addition, how would you define your ILS strategy going forward?
Sure. Well, it's been a difficult 5 years for retro. That's probably been the place that's been most beat up over the last 5 years with the catastrophe activity. And it's been difficult in ILS. And Markel, we have not been immune. Lodgepine, our team, they could not have worked harder. They did a wonderful job pulling together to try to put together an opportunity for investors and a market for insureds. But as we looked at it, given the struggles of the retro market and just the difficulty right now to raise capital, we just couldn't see our way to continuing with the retro. Right. So our plan going forward is really, from an ILS perspective, we're putting all our chips behind Nephila, and I think it's a great place to place our bets. Like I said, been in the business for over 24 years, and I would say they are the preeminent ILS manager. We're so delighted to have them part of our team, and we want to back them and that be our play in terms of ILS as we move forward.
Really. State Nationals recorded strong growth this year. What's your outlook for the program space, and how will that market evolve in the future?
Well, it's a great market right now, right? And the reason I know it's a great market is I used to count 2 or 3 or 4 competitors, and I can probably count over 20 competitors in the fronting market now. So the good thing about that is it's because it's a good opportunity that people are coming there, but it's also because there's a need. Program writers, MGAs, they have been growing substantially. And so there's been a growing need for fronting capacity, program services capacity. So we were up, I think, something like 38% in the first 9 months of the year at State National. We were already the largest fronting provider by a pretty wide margin in the business. And I think our scale and just brand in that market has really inured to our benefit. Obviously, also, programs are being driven by the same thing that's happening in the broader market. Price increases are coming through. The economy is recovering. All that is helping as well. So overused term, but it's a little bit of a perfect storm right now in the program services fronting space. And I think that's going to continue.
How do you view the Insurtech space, and what's Markel's approach to that area?
Yes, Insurtech, I tell you what, it's a lot of opportunity to learn. It's a lot of opportunity to bring new ideas into our business. There's a lot of really talented people attacking it, and there's a lot of capital being applied to it. So, we're looking to partner with people that we think have great ideas. We see it as a collaboration model. And so we've built a division inside Markel Insurtech Underwriters. It's really out there scouring the market to work with those Insurtech providers that we think have hopefully built a better mousetrap. 2 quick examples. One would be Thimble, which is a company that we work with that has really developed products with us for the gig economy. So we can provide products on an hourly weekly, monthly, or all the way up to a year basis to best suit the needs of that insurer. Great idea, great idea. Another great example is a company called Counterpart that we're working with on management liability. And what they have done is taken not just the information you can get from applications, but they're scraping data from other sources to really get the best view of risk and understanding of the insured so that we can provide the most accurate and most competitive price to them for their business, for their risk. So those are just two small examples, but I think Insurtech is wonderful because it's bringing fresh ideas and quite honestly, people into our business that might not have had any interest in the insurance business before. And, we've talked about this a lot as an industry. We need to attract more talent to our business. We've got a lot of baby boomers and others that are starting to retire. And where are we going to get the people? So Insurtech is a great way to get some really bright people that might not otherwise be interested in the insurance business into our business.
Right. Markel has made some major acquisitions in the past decade. What's your outlook for M&A in the insurance and reinsurance sector? And is Markel open to doing deals?
Well, it's definitely going to continue. I think there's been a little bit of a lull, and I would put that mostly down to organic growth is available. When you can grow organically and grow double digits or more organically, which a number of competitors are doing, and we are ourselves, you should focus the majority of your efforts on that organic growth. That is the most efficient way to grow your organization. We have certainly done a number of acquisitions in our history, and we've achieved growth through that. More importantly, though, we achieved capabilities. We brought new capabilities into our business. So we brought in State National and program services. We brought in Nephila with ILS. We bought Altera, which brought reinsurance capabilities to us. So we're more focused today when we think about acquisitions on capabilities, not just growth. It's a cycle. The insurance market experience is a cycle, and we won't be in a hard market part of the cycle forever. When things start to get tougher, acquisitions will become more attractive, I think, in general to people. At Markel, we're always open, we're always looking, but the key is we're looking for something that brings capabilities, and we don't want it to distract us from this great market opportunity that we have right now.
Absolutely, yeah. Your 2020 annual report stated that you wanted to grow 10 billion of annual insurance premiums in 5 years and earn 1 billion of annual underwriting profit while doing so. How will you get there?
Yeah, well, there's a multifaceted answer to that in terms of how we get there. That's all about profitable growth. And our rallying cry for that is 10-5-1. 10 billion of premium get to that in 5 years and have roughly $1 billion of underwriting profit, which, my high level math would say that's roughly a 90 combined. That's the goal for us. And profitable growth, that's going to virtually double what we're doing in terms of our insurance operations over the next 5 years. So I will say it's an organic goal. We really aren't thinking in terms of acquisitions when we think about that goal. And some of the growth strategies that we have here, we talked about going deeper in industry verticals, and we see things like registered investment advisors, construction, and life sciences as some areas that we really believe we can go deeper in and really help those customers and obviously help ourselves grow. We think geographical expansion could be part of that. We already have operations in Germany and the Netherlands and Spain and Canada. We've just recently opened a very small office in France, excuse me. And in Singapore, as an example, we have our renewable energy team is really based out of Singapore. So geography is certainly a part of what we're doing. Distribution, of course, you have to talk about distribution when you're talking about growth. And obviously, we have a tremendously strong relationship with the wholesale channel. But we also believe there's an opportunity on a select basis to grow in the retail channel in areas where wholesalers typically have not worked with retailers. Great example of that would be D&O. Very little D&O finds its way into the wholesale channel. Our goal is to make sure we manage channel conflicts as we do this, but we really do believe there's a great opportunity to grow there without disadvantaging our great wholesale partners. People. I mean, everybody has been talking about the talent war, about an overused term, but it's true. You can't do anything without the people. We have, through September, we had hired over 800 people at Markel, which was more than we had hired in all of 2019, which I'll say was the last normal year before COVID. So, with the growth that we're experiencing, with the talent war that's going on, it is critical to have the right people here. And we think our secret sauce, our competitive advantage is the culture at Markel, the Markel style. And that's what we're going to lean on hard to hopefully attract the right talent to Markel. And, so far this year it's worked, and we've attracted over 800, and I'm guessing we're going to be approaching 900 to close to 1,000 before the year is over. We've got to keep doing that. You can't do anything in this business without people. So it's multifaceted, as you can tell, and we're very optimistic about our opportunity to get there. If you were just to, take the straight average of what it's going to take to get to 10-5-1, we're ahead of the game right now. But I talked to our team and I explained, and they already realize this. Our market is always cycling. We have a great market right now, and old saying, we need to make hay while the sun is shining, because we don't know what the market will be like. We think it's going to be good in 22. We don't know what it's going to look like in 23, 24, and 25. So we need to be a little bit ahead when the market is good, so that we can make sure we make our goal over that 5-year period. We don't know what that back end of those 5 years is going to look like.
Totally. Richie, thank you so much for your time today.
Michael, thanks a lot. Really appreciate it.